Today, October 29, 2025, the stock market is buzzing with anticipation. The energy on Wall Street is electric, with traders and investors alike glued to their screens, watching every tick and headline. It's one of those days where every move feels significant, and the stakes are higher than ever. The S&P 500, Dow Jones, and Nasdaq are all climbing, led by tech stocks. These major indexes have been on a steady upward trajectory, reflecting growing optimism across the market. Tech giants are leading the charge, with investors piling into shares of companies they believe will benefit most from a friendlier economic environment. This isn't random. Investors are positioning for the Federal Reserve's big announcement. Every trade, every uptick, is a calculated bet on what the Fed will do next. Economic data is being scrutinized, and market participants are trying to get ahead of the curve. The FOMC wraps up its meeting today, and Wall Street is betting on a friendlier, more dovish Fed. Analysts are dissecting every word from Fed officials, searching for clues about the central bank's next move. The consensus is clear: a shift toward lower rates could be on the horizon. The expectation: a cut in interest rates, making borrowing cheaper and stocks more attractive. Lower rates mean businesses can borrow more easily, consumers can spend more, and the overall economy could get a much-needed boost. This is the scenario investors are hoping for. Investors are buying the rumor, acting before the official word. Trading volumes are surging as people try to get ahead of the news, hoping to lock in gains before the rest of the market reacts. It's a classic case of market psychology at work. The belief is that lower rates will boost company growth and make stocks shine compared to bonds. With bond yields expected to fall, equities become even more attractive, drawing in both institutional and retail investors looking for better returns. But it's a high-stakes game. If the Fed surprises with a tougher stance, this rally could reverse fast. Volatility is high, and a single, unexpected comment from the Fed could send shockwaves through the market, wiping out gains in an instant. Everyone's glued to their screens, waiting for the Fed's decision. Offices, trading floors, and even living rooms are filled with people anxiously awaiting the outcome, knowing that today's announcement could shape the financial landscape for months. The market's optimism is palpable, but the risk of disappointment is real. For every trader celebrating early gains, there's another bracing for a sudden reversal. The mood is a mix of hope and anxiety, as everyone tries to read the tea leaves. If the Fed delivers as expected, the rally could continue. Stocks could surge to new highs, and the sense of relief would be felt across the financial world. Investors are ready to celebrate, but only if the news matches their hopes. Any hint of concern about inflation, though, and the mood could shift instantly. The specter of rising prices still looms large, and the Fed must balance supporting growth with keeping inflation in check. Even a subtle warning could send markets tumbling. That's why this moment matters. The world is watching, and the stakes couldn't be higher. Global markets are tuned in, knowing that the Fed's decision will ripple far beyond U.S. borders, affecting currencies, commodities, and economies everywhere. The market is betting big, but nothing is guaranteed. Every investor knows that with great opportunity comes great risk, and today's outcome is anything but certain. Today's decision will set the tone for months to come. Whether it's a rally or a retreat, the effects will be felt long after the closing bell rings. It's a classic case of buy the rumor, wait for the news. Social media is abuzz with speculation, and every whisper can move the market in unexpected ways. The countdown to the Fed's announcement is on. In just moments, the world will know whether today's optimism was justified, or if a new wave of uncertainty is about to begin. The FOMC, or Federal Open Market Committee, is the Federal Reserve's powerful decision-making team, 12 individuals who have an enormous influence over the direction of the U.S. economy. They're not just economists or bankers, they're the people who steer the nation's money supply, making choices that affect every American, whether you realize it or not. These 12 members gather 8 times a year, sometimes more if needed, to set crucial interest rates and decide how much money should flow through France. Their meetings are scheduled well in advance, but the decisions they make can send shockwaves through financial markets in an instant. Their main goals are clear: keep prices stable so your money holds its value, and maximize employment so as many people as possible can find work. Balancing these two objectives is a constant challenge, especially when the economy faces unexpected twists and turns. The federal funds rate they set isn't just a number on a chart, it ripples through every loan, mortgage, and savings account in America. Whether you're buying a home, starting a business, or just saving for the future, their decisions impact your daily life. When inflation starts to rise and prices climb too quickly, the FOMC often hikes rates to cool things down. But when economic growth slows and jobs are at risk, they may cut rates to encourage spending and investment, hoping to spark new activity. Every word they say is dissected by Wall Street analysts, economists, and journalists, all searching for clues about what might happen next. Even a subtle hint can move markets and change the course of investments worldwide. Within the FOMC, there are often debates between hawks, who want higher rates to fight inflation, and doves, who prefer lower rates to boost jobs and growth. These internal disagreements can shape the direction of policy and influence the economy's future. Right now, the market is betting that the doves are in charge, expecting policies that favor growth and lower rates. This optimism can drive stock prices higher and encourage more risk-taking. The FOMC's decisions shape your financial life in ways you might not notice, from the interest rate on your credit card, to your ability to get a job, to how much you pay for groceries and gas. That's why their meetings are watched so closely by everyone from Wall Street traders to everyday families. The stakes are high, and the outcomes matter to us all. In this high-stakes game of economic strategy, the FOMC holds all the cards, and their next move could change your financial future. The market isn't just hoping for a rate cut, it's convinced it's coming. Odds for a cut today are nearly 100%, with another likely in December. This expectation is already baked into stock prices. Investors see the Fed starting a new cycle of easing to support a fragile economy. Ending. Quantitative tightening is also expected, signaling more cash in the system. Slowing corporate profits and economic uncertainty give the Fed cover to act. The market wants the Fed to cut rates now, not wait for trouble. Investors are betting on a series of cuts, not a one-off move. The real surprise will be in the Fed's outlook for the months ahead. If the Fed signals more cuts, stocks could surge. If not, expect volatility. Today's decision is about more than rates. It's about the Fed's entire strategy. The market is ready to react. It's earnings season, time for companies to reveal how they've performed. This week, 173 S&P 500 companies report results, giving us a real look at the economy. So far, 84% have beaten profit forecasts, the best rate since 2021, but growth is slowing. Third-quarter profits are up just 7.2% from last year, the smallest gain in 2 years. Companies are beating expectations, but the economic environment is getting tougher. Higher costs and weaker demand are squeezing profits. Big stock moves follow these reports. Regeneron soared, Royal Caribbean sank. For investors, this is a crucial test. Are companies living up to their promise? Strong earnings support the market rally, but slowing growth is a warning sign. The stakes for each report are higher than ever. The Magnificent Seven tech giants are driving the market, and this week is their earnings Super Bowl. These companies are not just industry leaders, they are market movers whose performance can set the tone for the entire financial landscape. 5 of the 7 report results, setting the tone for the entire market. Investors and analysts alike are on the edge of their seats, eagerly awaiting the numbers that could either boost or shake their confidence. Nvidia jumped 5% after announcing new AI partnerships and ambitious revenue targets. This surge is a testament to the growing importance of artificial intelligence in driving future growth. Microsoft rose on news of a massive stake in OpenAI, cementing its AI leadership. This move underscores the strategic importance of AI in the tech industry. These moves aren't just about quarterly profits, they're about shaping the future. The investments and partnerships being announced today will define the technological landscape of tomorrow. PayPal rallied on reports of deeper integration with ChatGPT, showing how AI is transforming e-commerce. This integration is expected to streamline transactions and enhance user experience. The ripple effects from these tech giants lift their partners and the whole market. When these companies succeed, their success cascades through the economy, benefiting a wide range of sectors. Investors are watching every announcement for signs of who will dominate the next decade. The stakes are incredibly high, and every detail is scrutinized for future implications. The stakes are huge. These companies' results can move the entire market. A single earnings report can trigger a market rally or a sell-off, affecting millions of investors. This week's tech earnings will echo for months. The decisions made and the results reported will have long-lasting impacts, influencing market sentiment and investment strategies. The excitement is real, and the pressure is on. Everyone from individual investors to large institutional players is keenly focused on these earnings reports. The market's fate is tied to these giants. Their performance can either buoy the market or drag it down, making their earnings reports critical events. All eyes are on their next move. The anticipation is palpable, as everyone waits to see what these tech giants will do next. Beyond the headlines, economic data tells the real story. Consumer confidence dipped but beat expectations. Americans are still spending. Housing surprised to the upside, with home prices rising despite higher mortgage rates. This wealth effect keeps homeowners feeling secure and willing to spend. Manufacturing is still contracting, but the latest report showed a big improvement. These signs of resilience complicate the Fed's decision. A strong economy argues against cutting rates, but risks remain. The Fed must balance optimism with caution, like every data point adds to the tension. Today's numbers make the Fed's job even tougher. The market isn't just watching the Fed. Trade and politics are in play too. A tentative US-China trade deal has removed the threat of massive tariffs, easing global fears. China agreed to buy more US goods and keep rare earth exports flowing, a win for American farmers and tech. But new tariffs on Canadian imports remind us trade policy is still volatile. Legal battles over tariffs add more uncertainty. Meanwhile, the government shutdown drags on, delaying key economic data and affecting hundreds of thousands of workers. The shutdown could distort unemployment numbers and slow the economy. These cross-currents create a fog of uncertainty for markets and policymakers. Every headline matters. The market is navigating a minefield of risks and opportunities. The US market is rallying, but the global picture is mixed. Europe's markets are cautious, weighed down by slow growth and energy worries. Asian markets are struggling. China's property sector is weak, and Japan faces its own challenges. The Bank of Japan's loose policy contrasts with the Fed's recent tightening. Global investors are watching the Fed, as US rate cuts affect currencies and capital flows. The US stands out for now, but global weakness could become a headwind. American tech and strong earnings are driving the rally, but no market is an island. If the world slows, US companies will feel it. The global economy matters to every investor. Today's divergence is striking, but it may not last. The world is watching the Fed and the US market. So, what does all this mean for you? If the Fed cuts rates, borrowing gets cheaper. Credit cards, car loans, and mortgages could see lower rates, but savers may earn less on their accounts, nudging people toward investing and spending. A rising stock market boosts retirement accounts and confidence. Strong companies hire more, fueling job growth. The Fed's moves ripple through every part of your financial life. When markets rally, your wealth grows. When they stumble, everyone feels it. Confidence and jobs are the foundation of the economy. The FOMC's decisions connect directly to your wallet. That's why today's announcement matters to everyone.